Welcome to the Rational Investing in an Irrational Market webinar. My name is Gary Mishers. I'm the Managing Partner and Chief Investment Officer of Silver Ring Value Partners. I also teach the Value Investing Seminar at the FW All-in Graduate School of Business. So let's get going. If you guys want to type questions in chat as we go along, that would be great. And I had a number of questions sent in advance, so I'll be covering those as well. And so the format is going to be, I'm going to talk a little bit about the current market environment, what some irrational things are, and how to stay rational. Then I'm going to try to answer the prepared questions that people sent in, and then I'll take on any questions that I can. And if you guys are listening to this live, if you could type in chat and just tell me how the sound quality is and what video, that would be much appreciated. So let's begin. I'm going to kind of not talk too much about myself because I'm not that interesting. Suffice it to say, I manage a concentrated long-term intrinsic value partnership where I manage capital for individuals, family offices, and foundations with a very long-term time horizon. And I'll skip stuff about Silver Ring and myself because that's not why we're here. You can certainly look it up on the web yourself. But let's focus on the situation today in the market. And let's talk about first, what does it mean to be rational, right? I'm going to start with Benjamin Graham. For those who have taken my value investing seminar, you guys know I start with security analysis. So this is a quote by Graham from Security Analysis. And I'll read the quote. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. So just food for thought. There's a lot to unpack here, but basically in layman's terms, what he's saying is basically, hey, basically make a decent amount of money and make sure you don't lose it, and do thorough work on the securities, right? That makes sense, right? So second quote I wanted to talk about today is by Peter Lynch, and I was fortunate. I started my career about 20 years ago at Fidelity in equity research, and of course, by then, Peter Lynch had already retired, but he was still an advisor to analysts and portfolio managers and kind of a senior mentor. And I had a chance to meet him several times when at Fidelity. So, it's someone I respect and admire. And one of the things he's very fond of saying is that in the stock market, the most important organ is the stomach. It's not the brain. So what does Peter mean? I think what he means is that it's great if you can analyze businesses, value them, and so forth, and if you see what should be done. The main question is, can you do that under duress in a frenetic market environment when the majority of people and market participants disagree with you? Can you avoid being scared, and can you avoid acting irrationally and following through on your analysis? That's what he means there. Our third quote is a very famous quote by Keynes, and that basically is that the market can remain irrational longer than you can remain solvent. So just because people are doing crazy things, right, it does not at all mean that they have to stop anytime soon. There's like no law that says, oh, people can only be irrational for 3 months and that's it. Then you got to go back to being rational. And nobody really knows how long people can stay rational. So I think while it's important to recognize that people, or that activity in the market might be irrational, I think it's important to maintain a long-term time horizon nonetheless, and not kind of bet the farm on, rationality returning, in the immediate future. Although in the long term, I strongly believe that it will. So let's talk about some signs of irrationality today. I'm not going to go in depth on this, but just to touch base here. So a company's stock recently traded higher after the company filed for bankruptcy. So let's think about what that means. Basically, the company filed for bankruptcy because they don't have enough money to pay its creditors. So presumably, most likely, the equity is worthless, right? Now, there's some crazy scenarios where maybe there's some value there, but certainly that news should not be followed by the stock trading higher. That's kind of a data point number one. We have money-losing storage stocks that are trading at near absurd, or I would argue in some cases, absurd valuations. Always interesting. Now, there was a stock in the last few months whose name sounds a bit like the infamous FANG stocks, but which has nothing to do with them, completely unrelated business. It went up 10 times, not 10%, not 100%, but 10 times intraday as retail investors piled in, confusing it for some FANG stock ETF. Right? Interesting, right? Thinking back to Graham's thorough analysis, maybe they forgot to do any analysis whatsoever, even to check what this company does. Now we have also a narrow group of companies and business models that are considered to be must own, and they're creating kind of their own highly valued tier in the market. By tier, I mean there's this grouping where membership in that group confers a very high valuation. And we've seen this in the past, right? In the late 90s, we've seen this when basically, we had anything that had to do with technology, media, and telecom had a high valuation. And in the 60s, it was the conglomerates and the one decision stocks and Nifty 50s. In the 20s, we had the radio stocks. I mean, this goes back a long time, right? So whenever there is this group where, in this case, this is an as, so software as a service, a platform as a service, whatever is a service, right? And if you start calling yourself a platform, you immediately get higher valuation. That's interesting, right? That's not very rational, I would argue. And then more recently, we've had stock split announcements causing mega cap stocks to spike in price despite no impact on company value. So imagine you're walking into a pizza place and you basically say, hey, I want a pizza pie. I remember last week I was here and you had this pizza pie for 15 bucks and you cut eight slices. Can I get the same pie? And the guy said behind the counter says, sure, you can get that pie, except it's $18 now. How come? It was 15 last week. Did you put some special ingredients in? No, but I cut it into 16 slices. Would that make sense to you guys? I don't think it would. It wouldn't make sense to me. It's the same pizza pie. It's the same size. It's the same thing. Cutting it into more slices doesn't make it more valuable. So we have these quote unquote analysts in quotes saying a great strategic move. This will allow retail investors, to buy, more shares. Now, think about this rationally. What kind of an investor can afford a $100 share, but not a $500 share or $400 share? There probably is some, but is this really a reason for a company to add tens of billions of dollars in market capitalization? I'll let you decide. I think not. Okay, so how do we stay rational given all of that's going on? So I think the first thing is you gotta play your own game, and that means stick to your process. So I used to, when I was in high school, I used to be the president of the chess club, and I organized a team, and but I studied initially. I learned on the streets of New York, playing in the park against people, kind of speed chess, right? And there is this very strong tendency when you're playing someone in chess, if they start making moves really quickly, boom, 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 like in your mind, you feel the need to respond, right, and move quickly as well. Well, that's a mistake. You should play at your own pace. You should not play quickly because the other person is playing quickly. Now, there are sometimes reasons to play quickly, like if you're running out of time in a time game. But that's not what I'm saying. You shouldn't try to respond to, basically the, to them by playing quickly yourself. That makes no sense, right? So I would say stick to your process and know what your process is. Be explicit, write it down. So I've written down my process in the owner's manual that I've shared with all the partners in the partnership, and I really stick to it. It actually not just serves as a tool to communicate to my investors, but also to keep me honest and to remind me of, hey, this is what I think is the best way to invest. Let me make sure what I'm doing is compliant with that. That's sticking to that. So stick to that. It doesn't have to be elaborate. But whatever your process is, write it down, stick to it. Don't change from that process unless you have a very good reason to evolve that process. All right. So second is really focus on your behavioral biases. What are some of these biases? Well, we have fear of missing out, FOMO, right? That it's pretty well known, right? That we have FOMO here. And if you see stocks go up and some of these platform companies or must-own stocks are going up and up and up, don't worry about it. Just stick to your process. If your process says you should buy them, buy them. If not, don't worry about it. It doesn't matter how you do compared to your friend, your neighbor, the benchmark in the short term. In the long term, obviously it matters that you exceed your opportunity cost, so you do better than you could have done otherwise. But in the short term, it really doesn't, or at least it shouldn't. And so resist the fear of missing out. So recency bias. So I think recency bias is when something happened recently, it seems more likely to happen again than it really should. So like if you, were passing on the street during a storm and lightning happened to strike right next to you, you would probably start to think that it's more likely for lightning to strike near you again than it actually is, right? But maybe a couple of months later, you wouldn't think that way anymore. So there's a recency bias, and one of these examples is everyone's talking about how value investing doesn't work. Value investing has underperformed. Growth is the way to go. You got to buy these amazing FANG stocks and whatnot. Okay, I get it. Maybe it's true, maybe it's not, but just be aware that some of this is influenced by the endpoint bias and what's been happening recently in the last couple of years. On the conversely, there's anchoring, right? You don't want to, anchor on your previous assessment of a value or a previous, taboo against owning certain kind of companies. You really want to be flexible and follow the evidence in your analysis, and try to update your opinion as information changes and as your analysis leads you to new conclusions. Not because other people are saying something or not saying something, but because from first principles you reach a different conclusion, which you should occasionally reach. It's okay to change your mind. You're allowed. I would argue we don't change our minds enough. The last thing I would say to guard against is a shortened time horizon. And that goes back to that speed chess analogy is, when everyone is earning 40, 30% returns in some group of stocks, you kind of start potentially being interested in saying, hey, I want a quick buck. I want to make some money now, not tomorrow, but now. And I think that that's a mistake. The expected return from equities, if we're lucky, is mid-single digits, right? So if let's say you do 10% this year, that's a pretty darn good return. Now, don't start to kind of expect that these businesses, which is what underlies owning stocks as businesses, are all of a sudden going to give you a quick return just because you want to, or just because other investors are making a quick buck in some kind of basically bubble group of companies. Don't worry about them. Stick to your process. So lastly, create outlets in your life to avoid taking unwarranted actions in the stock market. What do I mean by that? I mean, like, you could, say, well, I'm going to watch the market really carefully. I'm going to sit in front of the screen. I'm going to watch every movement. I'm going to keep analyzing as many stocks as I can. And I'm going to just, as soon as I see any opportunities, I'm going to act. So I think that can be a mistake. I'm not saying be lazy and don't do your work. Of course you should do your work. You should do your work very thoroughly. But what I'm saying is create an outlet for yourself that you find relaxing and peaceful, that prevents you from trying to force yourself to take action when maybe none is warranted. So for me, I'll speak to myself personally. I have two kind of hobbies. I like being outdoors, and I like bonsai, which is the kind of art of miniature trees, creating miniature trees from nursery stock or trees found in the wild. And I can go, in my kind of workshop and take a tree and spend 2-3 hours in the middle of the day and really get lost in the details of pruning these little branches or wiring and so forth. And that's actually good, because in a traditional world, in this big corporate world, it's like, well, oh, you're not working. What's going on? Well, but I am working. I'm working a lot, but I think it's important to give yourself a relaxing way for your mind to rest. And to me, working on a bonsai is almost a meditative experience. It relaxes the mind. It makes you focus on very small, controlled things, as opposed to sitting there in front of the screen saying, oh, should I buy more? Should I sell some of the stock? Or what should I do? Because look, you shouldn't be changing your investment positions that frequently anyway. So I would argue that create these outlets and don't be afraid. Go on a hike. Do whatever it is you like. Do that. It doesn't matter if the market is open. Yes, you want to make sure you're taking care of business, but beyond that, make sure you're letting your mind rest, because that's a well-rested mind is going to be much more likely to stick to your process and minimize behavioral biases. So let me go and try to answer the questions I've received over email. I'm gonna go in the order that I received. In some cases, I paraphrased the question. Hopefully, I didn't make too much of a change from the original. And there were a few late questions that didn't make it in this list. That's not because I don't want to answer them. Please, if I miss your question, just type it into chat, and I'll be happy to try to address it if I can. The one thing I'm going to say is I am not going to talk about specific securities or give investment opinions about sectors or something like that. And the reason for that is twofold. One is actually, I don't think it's helpful to you. Like, I think that investment professionals giving investment advice in a public setting is just really not, it's not helpful. Like, let's say I say, hey, I really like stock XYZ. It's mispriced. It's at $10. I think it should be at 20. Let's say some people go out and buy that. And what's going to happen is what happens if that stock goes to 5? Well, I'm going to have my own opinion of what to do. Maybe it's buy more. Maybe things have changed and I'm going to sell it. I'm not going to like keep updating people. And so someone can buy the stock at 10, maybe sell it at 5 because they're scared and they're panicked, and then maybe it does reach 20 eventually, and I held on or doubled down my position size, but they actually lost money. So I don't think it's actually helpful to give these kind of stock opinion in public. I certainly write in depth in my partnership letters to my partners. I occasionally do a kind of professional presentation in a few places where I present ideas, but I'm going to stay away from that. I hope that's doesn't disappoint many of you too much, but I think it's for good reason. I don't think it would be that helpful to say, oh, here's what I think about this stock, because I don't think this is what this webinar is about. So the first question is, how long can this disconnected market last at current valuations? Well, in theory, I think that it can last forever, but in practice it hasn't, right? So when someone, whoever sent that question, I went in and I looked at the last 3 kind of bubble markets, the 20s, the 60s, and the 90s, and about 3 years is when the majority of the excesses took place, and then they crashed. Now, does that mean that there is a rule that says after 3 years the bell rings and we go back to normal? No, there is no such rule. However, I think that it's hard for completely irrational behavior to persist. Random stuff does happen. And the mood changes, and once the momentum breaks, it can break very, very quickly. I mean, just study some. I was in MIT studying computer science and economics in the late '90s, and I started investing in these tech stocks before starting at Fidelity, and I was shocked how quickly they collapsed, because some of these companies were interviewing on campus, and they were the company to work for in some cases, and then they were bankrupt 6 months later, right? So these things can collapse very, very quickly. So the question is, how long will it last? I don't know. I think 3 years has been kind of roughly the time frame. I think, like, if you think about from 97 to 2000, and from in the late 20s, late 60s, but it can last a long time. So I think you don't want to plan on a certain end point, but I think you just want to stay rational and just follow the cash flow, follow the business analysis of the fundamentals of the business, the competitive advantage, how management is deploying capital. Focus on that and ignore the story. I mean, forget the charismatic CEO, promoting his own stock and playing games and whatever. That will wash itself out one way or the other over time. That's my view. But I would say 2018 is one, in my view, some of the biggest excesses started in this cycle. Up until then, things were, maybe expensive in parts, but fairly rational. And so we're kind of late in the tooth, in my opinion. But would I be surprised if this lasts a couple more years? I would be, but it can happen. All right, second question. So if you could recommend one investor for a newbie to study, who would it be? And, I'm going to give you a very boring answer, and I'm hopefully not too disappointing with this, but I still think it's Benjamin Graham. That's not to say that there hasn't been new thought to that since then, or you shouldn't study Warren Buffett, Phil Fisher. There's a ton of great investors. When I teach my value investing seminar, we go through a number of them, and I have an article on my website that talks about the sequence of the books I would recommend reading, so you can check that out under the Insights tab. It's probably maybe 6 months ago, something like that, because I get asked this question a lot. But I think Graham is the most simple and logical investor to understand. So I think that by understanding the basics and the basic principle of value investors, you can disagree with them then, or you can deviate or build upon them then. Then you can meet Phil Fisher and say, oh, I don't want to buy cheap stocks. I want to buy compounders and pay 30, 40 times earnings because I'm a great business analyst. Okay, fine. But at least understand Graham first. And so if you're a new investor, I would say The Intelligent Investor is a great book for a layperson to kind of understand the basics of why value investing. But then if you're a serious professional and you want to actually analyze stocks, I would say that you want to read security analysis. Not just read, study it. It's a dense book. There's 7 parts. I've read it 4 times. I've studied it with many people, and I still pick up new things here and there. So start there and then build on that, right? Because the Graham style of investing is easier to replicate than a more nuanced approach like Phil Fisher. Even though you can argue that maybe a well-executed approach as taught by Phil Fisher might result in higher returns, but it's also going to result in a lot of you making the mistake of thinking you can do something that maybe you can't and losing a lot of money. And no, I think a well-executed Graham approach guards you against losing a lot of money much more than others. All right, the third question. What are some signs a business or an industry are in a secular decline? So I think it's a good question. I think that, obviously one of the goals of a security analyst is to separate the cyclical from the secular, right? And, as you process information and interpret what it means, you definitely want to go and say, well, gee, is this indicative of a secular change or not? So one clear indication of secular decline is if during a healthy economic time, an industry is growing less than the economy or is shrinking. And so one example of a good business model that I've followed for 15 years that's kind of had trouble recently is that ad agencies, so companies like Omnicom, WPP, and so forth, they used to be growing at rates above the growth of GDP in good times. And then in this cycle, last 10 years or so, their organic growth rates really slowed down. So something is going on. Now, I'm not going to get into analyzing that, here on the webinar, but, that's an indication that, this business model used to grow above GDP, now is growing organically below. What are the secular changes? How much is temporary? What's going on? And so forth. So I think that's a good example. The other is like if you, for instance, if you can look at market share, right? So if you're looking at company-specific problems, you can separate the kind of demand for the overall category from the market share for the company. And if the market share is dropping, well, is that temporary? Is it a product cycle? Or is there a better or cheaper product or service? So those are a few things. But I think, look, it's a broad topic. I think it's a good question. I think something that we should all be keen on paying attention to. Number 4, how do you decide between selling and holding a fundamentally good business acquired at a low price that is now being priced by the market significantly above its intrinsic value? So I would say the question, and there's no such thing as a bad question, but I think the premise of the question I would maybe disagree with slightly. Meaning that I think a lot of the time, value investors are guilty of not updating their intrinsic value ranges often enough. And part of the reason is kind of endemic to value investing, right? So as a neophyte value investor, you kind of taught to look down on people who keep moving their price targets up as the stock goes up, right? That's what weak, quote unquote, analysts do to justify just owning an expensive stock, right? They don't really have a price target. Their price target is like a carrot attached to the donkey's head with a pole. As the donkey moves, the carrot moves, right? The price target is kind of a joke. If a certain bubble stock gets to 1,000, their price target is 1,200. If it gets to 1,200, it's going to be 1,500. If it's 1,500, it's going to be 1,800, right? It's not fundamentally driven. So, basically, I would say that the issue then is you definitely want to be responsive to new developments and update your intrinsic value. So if what's happening is that you bought a business at say 50, thinking it's worth 80, and the stock is now at 85, I don't think you should automatically sell. I think you should be really questioning, has that 80 changed, right? And now you have to guard against the temptation to just want to hold on, but you should also be open to the new developments. So one way in which I do is I have a thesis tracker. I literally color code each quarter for the company as in the 1 of 5 colors based on how did the company do relative to my expectations, right? So I essentially want to know versus my base case, and I have a range of values, but versus my most likely scenario, did the company exceed the one? I'm not talking about bottom line EPS, metrics or something like that. I'm talking about key operating metrics, things that are indicative of long-term health. And I would say that, that's very important, because if you see, so green means that they're doing better than expectations. If you see a bunch of green, several quarters in a row, maybe that's an indication that you should revalue the business. Maybe your base case was too conservative, which, by the way, happens a lot. Now, why does it happen? Well, it happens because when the stock is at 50 in that, hypothetical example, you don't need to push the envelope. If you think the conservative value is 80, that's plenty margin of safety to buy it probably for you. So you aren't going to quibble and think about whether it should be worth 100, not because whether it's 50 or sorry, whether it's 80 or 100, it's still something you're going to be very comfortable buying. So you can say, hey, if I'm a little conservative, so be it. So I think a lot of times when we buy a distressed stock, we're a bit too conservative on the value. And I think we want to make sure we're not too conservative, we're approximately right, and then we update this. But if I concluded the stock is above its intrinsic value, I would sell it. Because what that means to me is that the prospective return is below average, because that's what it means. If you calculate the net present value of cash flows and the stock is higher than that NPV, essentially it's embedding a lower rate of return than what your discount rate is, which is presumably related to your opportunity cost of capital. So I wouldn't own it, but I would make sure I double check before just automatically selling. So number 5, where should we look for investable companies and stocks? I think it's a good question. I have actually a video on my idea generation process that I will, when I post the replay, I will link to. But kind of the short answer is it depends, and it depends on your process and your style. So let's say you are a kind of value investor that likes to buy compounders. You're a Phil Fisher style investor, and that's what you're looking for. That's not necessarily gonna lead to the same idea generation process as someone who is more of a Ben Graham style of value investor, right? A Ben Graham style of value investor might look for, areas of distress, while as a Phil Fisher style investor might look for signs of fundamental secular growth, right? But let's give you kind of one idea. One idea is that you should be looking for things where there's forced selling, where it's just distress and like everyone hates it, or neglect. No one is looking, right? So why is that? Because those are the less efficient parts of the market. People are saying, oh, I would never touch a retail company with a 10-foot pole because retail is doomed. That's probably a good sign to start looking at something retail related. That's not to say, by the way, that's not a recommendation for you to go and buy retail companies. It's that if everything is being painted with a broad brush and the whole area is just hated and despised, or let's say not, oh, okay, Latin America is doomed, their coronavirus is going to be awful, they don't have the resources to battle it, they're shutting down their business environments. Okay, now look for areas of distress, and look for maybe areas within that are sold off, that are not necessarily going to be as negatively impacted or negatively impacted at all by what the source of concern is. Alternatively, kind of traditional value investor fare has been things like spin-offs and other special situations, because usually there's either forced selling or neglect. Nowadays, that's probably much better covered than it has been in the past. So even that part of the market has gotten to be more efficient. But I would still say that's a good place to look. Look for spin-offs. For instance, in the US, every time that a spin-off occurs, well, not every, most of the time, there's a form that's filed. It's a 10-12B, 12B/A. Sometimes they come via S1, but you can set up an SEC filing search for that, or Google's alerts, and you can catch a lot of them. Another area is a post-bankruptcy, right? Post-bankruptcy is great because a company is stigmatized and nobody wants to touch it. The financials aren't clean. They usually wipe out the debt in the bankruptcy process, or other leases or things like that. And the company coming out might be underfollowed, and there's no real incentive for anyone to sell it to you. Conversely, whenever there's a strong incentive for people to sell you things, like IPOs or secondary offerings, those tend to be negatively biased universe, meaning on average, those are not great areas to look for, even though they're individual ideas that could be good. All right, so I'll talk about the next two questions together. And basically, The first one, number 6, is asking, isn't using a 10% discount for equity cash flow to conserve? And that's 10% of what I use. And then number 7 is, how do you avoid valuation mistakes with respect to terminal value? So, so I think one useful mental model that I would share with you is that I think that when people start as value investors, they look at things in the very digital or binary form. They say something is either overvalued or it's undervalued, right? And so it's so my value, my NPV is 100 at 99 and it's undervalued, 101 it's overvalued. So it kind of creates this binary dichotomy. In the reality, think of if you were a business owner and you owned that whole stream of cash flows by virtue of owning the whole business, you would have some internal rate of return, right? Your IRR that you would enjoy if you were to keep that stream of cash flows from here to forever. When the stock goes from 99 to 101, the IRR changes very slightly, right? So it's not so in the mind of this kind of early stage value investor, you have this discontinuous jump between undervalued and overvalued, from good to bad, while the reality is much more analog as opposed to digital. Maybe the embedded IRR was 10.1%, and now the embedded IRR is 9.9%, right? It hasn't changed all that much. So I would argue, this is more with respect to question 7, with respect to terminal value, you want a big margin of safety. And the way you avoid valuation mistakes is twofold. One is really understanding the nature of the business, and at least being very comfortable with the worst case path for that business. And then, buying with a big margin of safety, because valuation is just not a precise thing. Like very few businesses can you say it's pinning down the range to within 10 or 20%. I would say almost none. I think, as a matter of fact, when I mentor kind of young analysts, one of the classical mistakes they make is they think that the range of values for the businesses that they're trying to value is much narrower than it actually is, and then they're shocked when something bad happens and the stock busts through their worst case, and they're like, oh, what's going on? They kind of have an identity crisis, while as what happened is the range of the probability distribution of values was much wider than they really gave it credit for. So I think avoiding valuation mistakes is, look for predictable businesses where you can be comfortable with the worst case value and then buy with a big margin of safety. Now, isn't using a test that these things do come about. I manage a very nimble partnership, meaning that I can deploy capital, in opportunities. For example, in March and April, I was able to add capital to investments at prices that were absurd, that a quarter of intrinsic value, right? So, I mean, if you think about the two mistakes you can make, let's say you lower your discount rate and say, well, the market, the 10-year bond is returning 0, so therefore I should be discounting at say 5 lines, and you being too conservative, and you say I'm going to get 0 for 3 years, but then after 3 years I'm going to get my 13, 14, 15% IRR, that I'm looking for when I underwrite my investments. I would go do that. I've done that exercise, and I can tell you can do it yourself and confirm that you're better off getting 0 for 3 years and then going ahead and getting a good IRR, rather than compromising and locking yourself into a 5-6% return over the whole period. That's just the math. Now, is it obviously hard? Can I point to a ton of easy 10% rates of return? No, I don't need to debate discount rates or betas or anything like that. I've already decided that, and mutually with my partners who gave me capital, what a good job looks like. Basically, excess return starts at 6%. So if I don't generate double-digit returns, I'm not really that excited, regardless of what the 10-year bond is doing or so forth. So yes, I am taking the risk that for a period of time I'm gonna miss out, but I strongly believe that over time, it's very unlikely that inflation has permanently disappeared, and especially, I'm not going to get into macroeconomics too much, but I would argue that there's greater risk to inflation today than not, and certainly being a little bit conservative on using a higher discount rate is prudent, as opposed to something I'm too concerned about. All right, great companies at fair price. So I'm gonna I'm gonna get on my soapbox a little bit because Warren Buffett, who is the seller, and he's not in the business, and he said this of committing capital at low rates of return on purpose. He's going to make mistakes. We're all human, but he's looking for high rates of return. So he doesn't buy them at fair prices. He buys them at prices he thinks are unfair. He just doesn't want to say it because it's bad business to say it because other people will not want to sell to him anyway. So I think what is better is more driven by your circle of competence than by what's better. Because if you are one of the 20 or 30 people in the world who can identify great businesses that are going to compound for 30 years at great rates of return, that will give you higher rates of return than cigar butt investing. But there's a whole crowd of people trying to copy these 30 people and quoting Charlie Munger and whoever, right, running around and talking about how Costco is amazing, and they think that they can do it, and in reality they can't, and they're going to lose a bunch of money because they're just paying really high prices for businesses that turn out to be not nearly as good as the price implied. So that's danger number one. The other point I would make about this is, yeah, this is kind of a false dichotomy. There's a whole continuum of investing. So does cigar butt investing still work? It still works. It's much harder to find. I have a couple of micro caps in my partnership that I own that are trading below liquidation value or at liquidation value with substantial businesses. So I think that they're very undervalued. But that's rare. I can't find another 5 of those, right? But there is a whole gamut of value investing approaches. I mean, I can say that for myself, I have a few investment patterns that I know I'm good at, and they kind of lie on that continuum. So, for instance, I believe I'm good at, finding situations where there's a temporary problem, but the stock is priced as if this is a permanent problem. So, telling the difference in temporary and permanent, whether it's a cyclical problem or a turnaround situation, and that works very well over time. Another thing I'm good at is figuring out when the duration of growth is misunderstood. So maybe a company that's growing at above average, but not amazingly high growth rates, let's say high single digits, but it's capable of doing that for 10, 20 years, and the market is pricing and it's like, they're going to revert to the mean pretty soon. And that's because I think of myself as a business analyst, and analyzing companies is something I think is my core competency, and so that I'm comfortable with. I am terrible at figuring out if a 20% growth company is going to be a 30% growth company. I just don't know how to do that. I respect people who can, and I don't know how to do it, but I know I don't know how to do it, so I don't try. I'm not saying it's wrong to do it. I'm saying it's difficult to do it, and I haven't figured it out. So I think the answer is not what's better in a vacuum. The answer is what is better for you, and what circle of competence can you develop and evolve over time to pursue that. Now, I'm going to pause. Those are the 8 questions I got. I'm going to pause, and there's some questions in chat. There are a couple of questions that came in, a little bit later into my email box. So I'm just going to pause for a second and try to answer them. So I think that one question I got is like macro driven, right? And the Fed, liquidity is being pumped into the market. How do you think about that? Does that distort the market? And how do we take it into account? Well, yes, I think the Fed is had a huge effect on this crisis. We can argue about its desirability, but I think it kind of squashed a lot of the free market price discovery in a number of securities. So, I mean, in some ways, it's potentially good because it's kind of propping up the economy and people spending, and I understand the Fed's game at a basic level. They want people to feel richer, so they go out and spend. And they don't want people to look at their savings accounts drop in value, so they feel even poorer after being furloughed and stop spending completely. So they're doing, they're playing kind of a little bit of a game. They're trying to prop up security prices as a way of creating, a wealth effect demand. Okay, I understand that. You can agree or disagree depending where you are on the political spectrum. But the reality is that that does prevent people who are distressed investing, investors from finding bargains as much, right? If this Fed didn't step into the high yield market, there would have been far more bargains in March and April and so forth. What does that mean going forward? I'm not sure. I mean, one question I have struggled with and I don't know is, what's the probability of, really high inflation? Right now, people aren't worried about that, but, you know, the one interpretation of the stock markets, move off the bottom is that it's only up a lot in dollars, but it's not the stock market that's up, but that it's the dollar has been devalued. But again, I'm a microeconomics expert. I'm not a macro expert, so I'm aware of these things. I'm maybe aware that I'm fortunate that in a small partnership like mine, I can take advantage of crazy prices quickly because I've done the homework, I have the value range ready, and I'm ready to act. But if you're managing billions of dollars, it's tough. You've seen Warren Buffett didn't really buy anything, right, of size during in March and April. Maybe it's because the values weren't deep enough, but some of it's because he manages a lot of money. And I think people who are very good investors but who manage a lot of money had trouble because the usual long period of distress where they could step up and buy billions of dollars of stuff just it was really compressed. Whether that's going to be the case going forward, or if this is an artifact of the nature of this crisis, or of the fact that this is an election year, who knows? But it's important. I just don't know the answers, unfortunately. So there was a question that came in. How do I spend my time? And it's a good question. So I used to be very structured, and I've changed to kind of a hybrid approach. So first of all, my goal is to spend 3/4 or more of my time on investing activities. I do these webinars. I occasionally, I write an article here and there, but that really doesn't take too much time. I'm not traveling and marketing, when I was spent 15 years prior to starting Silver Ring, 4 years ago, you are expected to do a lot of the road marketing as a portfolio manager at a lot of places. I don't do that. People find me, or they don't find me, that's fine either way, but I'm not out there trying to press flesh and pitch to financial advisors or something like that. It's just not the way I want to spend my time, and it's not, doesn't add anything to the investment process. So I would say at a high level, the goal is the meaningful majority of my time on investing. I would say there's some time, on operations, but it's pretty straightforward. It's not a lot. Some time on communications, and a little bit on, kind of talking to potential investors because it is important. And I think that partnering with the right investors creates a portion of the competitive advantage, which is the right duration of capital. And as an example, I'm proud of my investor base, in part because they acted long term. In March and April, I received 0 phone calls of concern, and I received additional capital, which allowed me to deploy at very advantageous prices. And I would say that is unusual for investors where most of them are kind of running for the hills, worried about the stock market falling. So I think that communicating to them and maybe over communicating and educating them about my process up front, even though it's somewhat time consuming, creates a real competitive advantage in terms of behavior that you want, which is to be counter-cyclical in how they deploy capital with the partnership. In terms of dividing it between different investment categories, I would say I spend a fair amount of my time on maintenance, and I try to balance it, cycles. So earnings seasons more tends to be a maintenance period of time. Then maintenance doesn't go away; it still stays there. More longer-term maintenance, doing primary research, like trying to create. Like I like to create a devil's advocate kind of point of view. Try to come up with a negative, strongest negative case against my biggest positions, and try to figure out, if it's true or not. So those are kind of important but not urgent kind of things that I do that's not during earnings season. But I run probably 8 times a year a formalized idea generation process, which I talk about I have a video that talks about how the product of that idea. Just put a question in chat. Now is the opportunity. So let me see here. So I think there was a question. There was a question about comparing what's performed in real life for a lot of business. Stress test not to customers not wanting their goods and services, but stress test to companies not being able to buy the goods and services. So one good example is I didn't own it, but there was a company that distributes dental products to dentists. And that historically was a very resilient business. It's very non-cyclical because there's a little bit of cyclicality in how much people visit dentists, but not much, right? And you would, if you looked at prior recessions as an analog, you might have concluded that, hey, this is a pre-recession resistant business. It's pretty resilient. Well, this business was down like 60, 70% at the trough because dentists were mostly deemed non-essential and were just shut down, right? So I think this is why you really need to think about investing from a first principles basis. And yes, you should study history, but I think assuming that the next of the prior cycles or it's the same as the worst cycle of the last five, I don't think that's the right mental model. I think the right mental model is to study past cycles, but acknowledge that things can be worse in different ways. So I think 07 because of housing. 02, 03 was a business investment driven cycle because of telecom overinvestment and overinvestment in other areas, which so the kinds of businesses that suffer the most differs. But I don't have an opinion about whether we're going to go into a V recovery, L, W, U, who knows. What I do know is that there is a big disconnect, as we all know, between the market and the economy. I would say that at some point the two need to reconnect. It's either by the market going down if the businesses keep earning a lot less than they used to, or by the company's profitability being restored. In which direction it's going to go, I'm not sure. And by the way, I don't think there are people who are sure, but they're wrong to be sure. They should be cautious in being sure, but I think that they should be instead trying to make sure that they're managing risk and they don't just have a portfolio where if there's a quick recovery, they win, or if there's not a quick recovery, they win. They should try to manage risk across a variety of potential paths the world can take and make sure that they don't do too badly in any of those. And hopefully pretty here. Let's see questions. All right, so I had a question. Do I have a preferred valuation framework to assess attractiveness of an investment? I use a discounted cash flow analysis of equity free cash flow. I do adjust for leverage if the company is over levered, or mostly if it's over levered. But I think it's a pretty good analog for what it would look like if I were to own the whole business outright. So I find that to be pretty representative. I also like looking at 7-year trailing free cash flow divided by the current market cap. And that what that does is a quick metric, but it pretty quickly tells me a bunch of things. It eliminates frauds, right? Because a lot of times frauds don't have free cash flow. It doesn't eliminate them all, but it eliminates a bunch of them. It eliminates companies that have really poor quality of earnings, and it gives me a sense of, okay, if the last and by the way, 7 years not fixed in stone. It's meant to be representative of a business cycle. So the reason we don't use 20 years is because businesses change. High single digits, right, as a starting point, at least mid single digits. If this company on average 2% of its market cap and free cash flow over the last 7-8 years, I'm just not interested. Now you can say, well, that misses the point. They're great compounders and great software companies. Yeah, there are. Okay, I'll miss them. I already said that there are things that I know I can't evaluate. I'm going to pass. So I know my circle of competence, and I'm very comfortable sticking to it. And so I understand I'm going to make type 2 error, mistakes of omission, and that's okay. Now, by the way, there are times when the reported, free cash flow is actually not representative of the real free cash flow. So I do dig in, obviously, into the numbers. But I'm saying as a first pass, that's probably a pretty good yardstick and pretty representative of the kinds of free cash flow rich businesses that I look for. But a DCF I think is perfectly fine. By the way, don't make a DCF too complicated. Like, your ability to understand the business is not so precise that you can get the value to the nearest decimal point. Approximately right is the goal here, right? So we have a question. Do I have so I'm just going to read it from the chat. If you're presented with a potential investment, say a company stock, do you have a standard back of the napkin set of calculations that you check before diving deeper? I guess, no, I definitely want to make sure that over time, the return on invested capital is at least comparable or higher, preferably higher than the cost of capital. I tend to try to eliminate bad businesses. And some people say, why? Because isn't there a price for everything? There is. And sometimes I make exceptions if there's asset value, that's different. But on the going concern basis, I just think that bad businesses are just too tough to come up with a narrow enough range of values to be useful and to make a good investment. So, if a company just chronically under earning and it's earning 5% return on capital, you know what? I'll let someone else make the money. So return on capital will be a good starting point. I like to make sure that free cash flow to net income over time is, within some range. I would say less than 50%, and that would raise my eyebrows, because net income should be a proxy for smooth free cash flow, right? And to the degree that essentially, free cash flow is much lower than net income, that either the company is investing, which, I would investigate, or the net income really isn't real and just a bunch of management adjustments to make their earnings look better than they are. And as I said, just talked about earlier, I do like to look at trailing free cash flow yield on a kind of average basis. And also I try to quickly get a sense of what's priced to kind of a forward-looking normalized mid-cycle earnings per share. And that tells me, so that basically tells me quantitatively a very nice picture of the company. I also look at financial leverage. I want to make sure that this is, there's not some kind of a crazy situation where it's not a stub, meaning it's not a 7 times debt to EBITDA business or something like that. And I think those things tell me quantitatively. There's obviously a whole lot more analysis to be done. I like to read the proxy statement to see how the management is incented. I like to understand, the nature of the business, frankly, is one of the first things I look at, just to understand, is the kind of business, is what they do something within my circle of competence to assess, right? And a lot of businesses fail that criteria. All right, so hopefully that was at least a start to answering that question. There was a question in chat, in the YouTube chat, of how many stocks should one hold in their portfolio? It happens to me sometimes I restrict myself to, let's say, 15, but a week later I get tempted to enter into a couple of more. How do I avoid that? Well, first of all, if you can find 2 new investments in a week, either kudos to you and you're amazing, and by the way, I'm sure you are amazing as a human being. I'm saying you're an amazing investor, or maybe your standards, could use tightening, right? Because it's pretty darn hard to find investments these days, or in any environment. In most environments, maybe in some environments it's easy. And so, I probably average 2 or 3 months to find a new idea, right? And so again, just be careful. If too many things look attractive, maybe you need to reassess your standards. But how many stocks? It's really a function of what kind of investments you own and how deep your due diligence is, what the downside is, and also what's your style. So if you are a Phil Fisher investor and you're looking for outliers, right? You're looking for the very few companies that can potentially compound capital at very high rates for a long time. Guess what? There's just not that many of those. And by the way, if you meet some guy who's a portfolio manager and he is, running a 100 stock portfolio claiming to be a Phil Fisher investor, he's not. He just either doesn't understand what that means, or he's kidding himself, or he's deceiving you, because just very few companies pass the qualitative and financial metrics to be the potential compounder. So if you're focusing on these compounders, you're naturally going to be very, very, very concentrated, right? Maybe even fewer than 10. 5 to 10 would be a reasonable number for people who I know who are good at that. On the other hand, if you're following more of a Graham approach and looking for more reversion to the mean, then you might be much more diversified. I would say maybe 20, 30 investments, because some of them might be similar companies in the same industry, but with slightly different variations to diversify a little bit. It's basically the same position expressed in a few different ways. But I would say if you have more than 20 or more than 25, you got to ask yourself, is that 21st or that 25th investment really worth it to dilute the first 19 or the first 24? In most cases, it's not. Most mutual funds, by the way, I spent 15 years in the mutual fund industry prior to starting out on my own. Most mutual funds are not diversified because it's optimal. They're diversified for 2 reasons. One is many of them are managing way too much capital, so they have to be diversified, right? They can't invest enough because they can't own more than, say, 15% of a single company, so they have to put in 100 companies, 200 companies, whatever the case is. So it's not something that they would do if they had the choice, but they have too much assets, right? The second reason is they're afraid of producing lumpy returns for their investors, right? Because they're afraid of losing business. So they're not doing it because it's optimal from an investment point of view. They're doing it for business reasons. And if you one big advantage you as an individual investor have is that you don't have to do stupid stuff for business reasons, because your business presumably is to get the best safe return you can, right? And so, you shouldn't key off someone else's number of ideas. Now, look, there are people who've been amazing investors with a large number of investments, like Peter Lynch, right? That's not to say that everyone who has a lot of investments is, stupid or something like that. But I don't know anyone who, with their own capital, would say, "Oh, I really need over 100 investments to feel safe." Because a lot of times, if you need 100 investments to feel safe, I'm not sure you know what you're doing. Or you're running some kind of quantitative factor strategy, and that's different from what I do. And I certainly there are people who know a lot more about that than I do, but I'm talking about fundamental kind of bottom-up investing. So I'm not seeing a ton more questions here. We're near the top of the hour. So maybe they should just wrap up here. Some conclusions. So one is, I would say, judge yourself on how well you execute your process, not based on the short-term feedback that the stock market gives you. I think that's very important. Two is focus on being a good analyst of businesses and on being disciplined on price. And the third is be kind to yourself, right? We're all going to make mistakes. I'm going to make mistakes. You're probably going to make mistakes. Just learn from them and improve. I have 3 kids, and I'm very careful whenever they make a mistake that they essentially, rather than being hard on them, I say, okay, not a big deal. It's a good thing you acknowledged it, and let's do better next time. So I think having that kind of growth mindset is going to be really helpful. With that, I think this is, by the way, the "Don't Sue Me" slide. I hope you can read it very quickly. And if you want to learn more, I'm happy to share my owner's manual with you. Send me an email. The email address is on the screen. It's free. It's the same owner's manual that I share with my partners, where I basically explain my investment process in depth. I'm happy to send it to you, whether you're a prospective investor or whether you're just a student trying to learn. I don't care. I'm very happy to essentially send that, and hopefully it'll be of help to you. And let's stay in touch. Always happy to talk with like-minded people. And if this has been helpful to you, when the replay comes out, or if you are watching the replay, please share with your friends and those who are like-minded that are interested in long-term investing. With that, thank you guys for your time, and I hope this has been helpful. Take care.